In this lesson, we basically want to look at another important technical thing that is under the International Financial Reporting Standard 15. That is revenue from contracts with customers. As established in our previous video on this particular standard, we know that an entity must go through the 5-step approach in recognizing revenue anytime there is a contract between the entity and the customer. And this 5-step approach are: you identify the contract with the customer, you identify the separate performance obligation, you determine your transaction price, and then you allocate your transaction price to the various performance obligation, and then you recognize revenue when or as and when you satisfy the performance obligation. So the step 5 basically talks about we recognize revenue, so step 5 talks about recognize revenue when or as and when performance obligation is satisfied. We already have a lesson explaining all the important things under the various steps from the step 1 to step 4. Today, our focus is going to be on step 5, the most important thing that we are supposed to know, the principles and the concepts we are supposed to know under step 5. That will help us in understanding the standard as a whole, and also helping us to solve all practical questions whenever they fall due. So again, if you've not watched the video on the 5-step approach, there is one already uploaded. You can quickly watch to be at par with us with this current lesson. Okay, so let's come back to the step 5. We know that we've already understand step 1 to 4. Now, with the step 5, we are saying that the entity should recognize revenue when or as and when the performance obligation is satisfied. We establish that performance obligation is basically the promised goods and services, or it can either be a bundle of goods and services or a distinct goods and services that the entity at the date or at the inception of the contract promised the customer to deliver to the customer in question. We are saying that this performance obligation here is, you can only recognize revenue when you have satisfied this performance obligation. Now the issue is, when does the entity satisfy the performance obligation? According to the standard, an entity can satisfy the performance obligation under 2 scenarios, or maybe under 2 categories. So the performance obligation can be satisfied by the entity at a point in time, or over time. So it's either the entity satisfy the performance obligation at a point in time, or satisfy the performance obligation over time. What does the standard say if an entity is satisfying its performance obligation at a point in time? At the inception of every contract with the customer, the entity must determine whether the performance obligation will be satisfied at a point in time or will be satisfied over time. When it is at a point in time, then we don't have too much issue over here. With that, we are saying that just in one shot, you can recognize your revenue because you provide or you satisfy your performance obligation. For instance, let's assume that at the inception of the contract, we are supposed to just provide 10 boxes of marker to the customer. So once you have delivered these 10 boxes of marker to the customer, and then maybe it's at the selling price of, so let's say $100, then just when you have delivered the 10 boxes of marker to the customer, and then the consideration has also been paid by the customer, then immediately you can recognize your revenue, because this particular type of performance obligation is satisfied at a point in time, just one shot. So mostly what helps us to note that a particular performance obligation is satisfied at a point in time is just a one-shot something. So with that one, you provide the performance obligation and then you just recognize your revenue, because this type of performance obligation is satisfied just in one shot. In some instances, what will help us to notice is when we have passed control to the customer, or the risk and reward that is pertaining to the performance obligation has been transferred to the customer. Anytime such things happen, then we are saying that we have performed or satisfied a performance obligation at a point in time. But there are some few issues that comes with the performance obligation that is satisfied at a point in time, and they are the consignment inventory. We also have repurchase agreement. We may also have the build and hold arrangement. All these are some of the few exceptions that comes with anytime the entity is trying to perform its performance obligation at a point in time. Sometimes, as we established in the previous video, the entity may be performing the bundle of performance obligation. For instance, we may sell a software. So we may sell a software and then provide maybe installation services for or update of the software for some period of time. Here we are supposed to differentiate whether the software installment is going to be a separate performance obligation with the update and the service you are going to provide after the sale of the software. If the software is going to be a separate performance obligation to the installation and update services, then we are supposed to note, or we are supposed to take into consideration how long we are providing the technical service for the software and how much consideration we are going to get from the additional services we are providing to the customer. If that is the case, probably that will fall under it is still going to fall under the performance obligation satisfied at the point in time, by just that it comes with the step 2, where we say we have bundle of performance obligation, or we have distinct performance obligation. So this one is just one shot, just at a point in time, but this is going to be satisfied separately, and this is covered under the step 2. If you don't have an in-depth knowledge about the step 2, you can watch our previous video on it to establish your understanding. So basically, when a performance obligation is satisfied at a point in time, it doesn't come with any complication, because at the inception of the contract, you probably just deliver the performance obligation. It's just within a year or within a period. It's just one shot. It doesn't proceed. It doesn't continue. Just one shot. That is when you are trying to satisfy a performance obligation at a point in time by an entity. Small complications arises anytime the entity performs its performance obligation over time, or satisfy its performance obligation over time. So anytime the entity has identified that the performance obligation is going to be satisfied over time, then it comes with some small, complications. Now, the standard established that for us to know that a particular performance obligation is satisfied over time, then some criteria must be met, or some conditions must be present for us to know that this particular performance obligation is satisfied over time. And then these criteria are 3 in number. 1, the customer must simultaneously receive and enjoy the benefits provided by the performance of the entity. So if the customer simultaneously receives and then enjoy the benefit provided by the customer's performance, then we are saying that that particular contract or that particular agreement between the entity and the customer, the performance obligation will be performed over time. Second one is that the entity's performance creates or enhances an asset which is controlled or used by the customer. So anytime the performance obligation will, at a point in time, will create an asset to the customer, then we say that that performance obligation is satisfied over time. And the third one is that the performance obligation or the entity's performance will create an asset that does not have an alternative use to the entity. So the entity's performance will create an asset, and this asset does not have an alternative use to the entity, and that it is probable that the entity is going to collect its consideration from the customer. So if such three conditions or three criteria are present, then we know that the entity is performing or satisfying its performance obligation over time. In most instances, an entity will perform or will satisfy a performance obligation when the performance obligation in question is a manufacturing of a building or construction of a building. So it's the construction of the building that will take more than one period, will take more than one accounting period before you will be done satisfying your performance obligation. So in this case, in just simple terms, when it comes to satisfying performance obligation over time, this is where the entity will take a longer period of duration to complete or to satisfy all the performance obligation. This means that at the end of an accounting period, we want to know how much revenue you are going to recognize in the books as and when you have satisfied the part of the performance obligation. So let's assume that you have undertaken a contract with the customer to construct a building for the customer, which is going to last for 5 years. So, we cannot, according to the framework, we have to match our revenue to our expenses. So if in year one, you have performed some of the contracts, some of the building, and that building have met part of such conditions we've established earlier, then we are saying that in year one, you are supposed to recognize some part of the consideration as revenue. And then you also recognize some cost. You come to the cost. We come to contract cost and we look at what goes into it. And then once you get your revenue and you get your cost, you can establish your profit from the contract. So here, the most important thing is, how do we get the profit for this one, the first year? Or in fact, if you are dealing with the year 2, how do we get the profit? If you are dealing with the year 3, how do we get the profit or the revenue to be recognized in the books of the entity? That is what we are going to go extensively into in this particular lesson. All right, so performance obligation satisfied over time. What are we supposed to look out for? Because most of your practical questions may probably come from this step 5. Now, anytime a performance obligation is satisfied over time, as we have established earlier on, then at the end of a financial period, we are supposed to determine the progress of completion of the contract. All right, so like established earlier on, let's assume that we are performing a contract for a customer that is going to take us 5 years. Then at the end of each reporting period, we have to ascertain the progress of the contract. In other words, we have to know the percentage of completion of the product of the contract. So we are taking 5 years. Then at the end of year one, we want to know how much we can send to our books or our financial statement as revenue, and then as our cost and as our profit, by ascertaining the percentage of what? The percentage of completion or the progress of the contract. The standard prescribes two ways of doing this. It's either, or two methods of doing this. It's either we use the input method, or we use the output method. Now remember, these methods are just there to help us in ascertaining or knowing the percentage of progress of a particular contract or of a particular service that we are providing to a customer, using or where the performance obligation is satisfied over time. So if this is the case, what are we expecting in the input method? In the input method, we are basically looking at the cost incurred to date as compared to the total cost or the total cost of the contract in question. Then it will help us in ascertaining the progress of what? The percentage of progress or the percentage of complete as at the year in question. Then when it comes to the output method, we are basically looking at the output. We can look at the work certified over the contract price or the duration used over the total duration of the contract. With the output method, we are looking at what you have actually done. So what you have actually put up, the output of the contract. That is what we are going to use in determining our progress, so that it can help us in determining our revenue. So in all, remember that anytime the contract is performed or the performance obligation is satisfied over time, then at the year end, at any reporting period, you are supposed to ascertain the percentage of progress. And in doing that, this percentage of progress, you can either use the input method or you will use an output method. In almost all questions, you will be informed which method you should use. But if you are not informed, there are some things that you will see in the question that should inform you that you should use the input method. For instance, if you have cost to date, the cost to complete, then you are supposed to use the input, because that one we are dealing with what goes into the construction or what goes into the satisfying of the performance obligation. And then with the output, we are looking at what we have done up to the date. So we are going to look at the work certified against our contract price, and you will help you to determine your your percentage of progress. Anytime a performance obligation is satisfied over time, then there are some few steps we are supposed to consider, at least about 4 of the steps. So let's go through the steps and see what we are supposed to, or what we are expected to do. Now, with this step 1, anytime you are given a question and this question pertains to a contract or a performance obligation that will be satisfied over time, then the first one is to determine your overall profit or loss. So the first point is determine your overall profit or loss. And how do we do that? It's basically your contract price. So let's have it over here. Let's see, the currency is $, and then we will less our cost to date. We less that from our contract price, and then we also less our cost to complete. We also less that. So this will give us our overall profit or loss. So if it's a profit, it's going to be a positive figure, but if it's a loss, it's going to be a negative figure. So that is step 1. So anytime you are given a question, the question will probably provide you with your contract price, your cost to date, or your cost to complete. Remember that the summation of your cost to date gives you your total cost. The summation of this and this gives you your total cost. If that is the case, anytime you are given the cost to date and the total cost, then you can ascertain your cost to complete. So let's assume that we have our cost to date to be $100 and then our total cost to be $150. Then at any point in time, we can say that the cost to complete is going to be the difference between the cost to date and the total cost. Your cost to complete will be the difference between the cost to date and the total cost, and this is going to give us $50. So let's take note of that. So anytime we are given the cost to date and then your total cost, you can determine your cost to complete. And on the other hand, in the same vein, if you are given your cost to complete and the total cost, you can also ascertain your cost to date. You can also say that for us to get the overall profit, you can just bring your contract price, and then you bring your total cost over here. So once you less your total cost, if that gives you the profit or loss, that is the overall profit or the overall loss. Now, the important rule you're supposed to know before we move to step 2, there is an important rule you are supposed to note over here. Now, the rule is in 3 forms. Anytime you compute for your overall profit or loss, and then you get profit, so this is an overall profit, you get an overall profit, then you must do 2 things in the financial statement of the entity. You must ascertain your revenue, and then you must ascertain your cost of sale, so that the 2 of these, if you less your cost of sale from your revenue, you will get a profit. You get your profit over here. This is the actual profit we are talking about. You get your profit over here. So anytime after doing the overall profit or loss and you get a profit over here, then you proceed to do your calculate for the revenue and then the cost of sale. We will look at how to calculate for revenue and cost of sale in one of the steps. Now, what about if the overall calculations is giving you an overall loss? Anytime you done or you want to determine the overall profit or loss and you end up getting a loss, then the standard prescribes that the whole loss should be treated as an expense immediately in the books of or in the financial statement of the entity, that is the statement of profit or loss as loss. So assuming that you've calculated this and you had a loss of $2,000, which is a loss, then you probably have to still ascertain your revenue and in the cost of sale. So once you have ascertained your revenue and your cost of sale, the loss that you will get should be amount to the overall loss. If it is not amount, you made a provision so that you get this overall loss. We will take a question and you will look at how it goes. And then the last rule is that if you cannot determine the overall profit or loss, then your cost to date that you can recover from the customer should be considered as your revenue. And then your cost will probably be the same amount, and therefore the effect will always give you a 0 profit or a 0 loss. So this is the basic rule, 3 rules. If you do this and you have profit, determine your revenue and determine your cost of sale. And then you probably determine the actual profit to be recognized. If you do this overall profit or loss step 1 and then you get loss, then remember that if you do this, the loss that you get should be equal to the overall loss over here. If it's not, you have to make a provision to make it equal. If you cannot determine the overall profit, there is no information to determine that, then your cost to date should be of your revenue, and then the cost of sale will probably be the same cost to date, and therefore the effect will be will be 0. Now let's move to step 2. What are we supposed to do under step 2? Alright, so in step 2, after you have determined your overall profit or overall loss in step 1, then step 2, we want to look at the percentage of progress, because this percentage of progress will help us in step 3. to determine our revenue and our cost of sale. Now, how do we determine our percentage of progress? This one depends on the method you are using. It's either you are using the input method. So if you are using the input method, then it's going to be your cost to date, over your total cost multiplied by 100 will give you the percentage of progress. So remember that if you are dealing with the input method, then it's going to be your cost to date over your total cost multiplied by 100%, which will give you the percentage of progress. Now, if you are using the output method, then it's going to be your work certified over your contract price multiplied by 100%. So it's either you are using the input method or you are using the output method. So if you are using the input method, remember that it's going to be your cost to date divided by your total cost. And then if you are using your output method, then it's going to be your work certified over your contract price. In every or almost every questions, you will be informed as to which of the method you should use. But in case you are not informed, look at the variables over here, which one is present in the question. If you have work certified, you have contract price, then you can use the output method. But if you have your cost to date and total cost, you can also use your input method to ascertain your percentage of progress. Now, having understood step 2, let's move to step 3. Now, with step 3, is basically determining the profit or loss to be sent to our P or L account. That is about step 3. So it's basically determining the profit or loss that will be sent to our P or L account. In other words, we want to determine our revenue and our cost of sale. So here, what will be your revenue over here? So your revenue over here is going to be your contract price in the question multiplied by the percentage of progress, what you have calculated in step 2 using any of the 2 methods. So percentage of progress. This gives you your revenue. That is your revenue. And then you have to determine your cost of sale. Now, your cost of sale. Now, your cost of sale comprises of 2 things. It's going to be your cost to date multiplied by progress, percentage of progress, that will give you one of the cost to date via lesson, and then the next one is cost to complete. The same way, multiply by, this should be under here, cost to complete. Multiply by the percentage of progress. So the summation of these 2 costs gives us our cost of sale. So once you less this one from this, we should either get our profit. So if you remember the general rule after step 1, anytime you will get profit, then here should also be profit. So this is what I was talking about. Anytime the overall determination of overall profit or loss, then you get profit, then here must also be profit. But if you get a loss over there, then here must be also loss, and this loss must be equivalent or must be equal to the overall loss. So you see that you get a loss or profit here depending on what you are going to get in step 1, your overall profit or your overall loss. So remember, this is basically a POL item. So now to there is something you can also do here. Now that you are seeing your cost to date and your cost to complete, and the two of them is going to give us our total cost, you can basically say that your cost of sale is your total cost multiplied by your percentage of progress. So we'll give you your cost to date. In the same vein, if you are giving your cost to date and your total cost, you can ascertain your cost to complete by just trying to find the difference between the cost to date and then the total cost. Now the next step will probably be the step 4, and that will be the last one for that matter. Alright, so with step 4 is basically to determine your contract assets or your contract liability. That is step 4, and this is basically what you are supposed to send to your statement of financial position, your balance sheet. So you see that to ascertain your contract asset, your contract liability. And how do we get that? It's basically your cost to date, which is here, the cost to date, and then you add the profit you have ascertained in step 3. You add that profit. Please, not the step 1 profit, not the overall profit, the one that you ascertain in step 3. So you add your profit. So remember that if it is a loss that you are getting, you are going to less. So either we are adding profit or we are lessening our loss, and then you less the amount billed to date. To date, you less the amount. So whatever you get is either you get contract assets or contract liability. Now, what is the amount billed to date? The amount billed to date is the amount you are going to receive from the customer at the date that you are trying to prepare your financial statement or the reporting date. Okay, that is going to be the amount billed to date, the amount that you are going to receive from your customer, not the total consideration of the contract. So this will give you your contract asset or your contract liability. So basically, this is how to determine your contract asset or contract liability. Now, the standard does not prescribe how we should account for the contract asset or the contract liability. So it doesn't prescribe or give any description of the contract asset or contract liability. But once you have ascertained it, remember that it is going to be a statement of financial position item, which is going to be under your current assets. Now that we have understood these steps, the most important thing is taking a practical question and going through them to establish our understanding of what we have learned. So let's take a practical question. Remember that all questions will have a link in the description. So once you click on the link, you'll get access to all the questions we are going to use in establishing our understanding. Alright, so in the first question, we were told that the following information relates to a construction contract. We were given the estimated contract revenue, that is a contract price. We were given the cost to date. We were given the estimated cost to complete, and we were given the estimated stage of completion. Here, we were given the percentage progress to be 60%. And we were given the various values, the contract price, which is the contract revenue to be $800,000. We have the cost to date to be $320, and you have the cost to complete to be $280 over here in the question. And then what amount of revenue? The requirement is what amount of revenue and cost and profit should be recognized in the statement of profit or loss. And then they say we should take the same contract, but now we should assume that there is no reliable estimate that the outcome of the contract, although it is believed that all costs incurred will be recoverable from the customer. So with the B, we are told that we don't have any information. We should assume that we don't have information to ascertain the profit or the revenue or cost of the contract. So what amount should be recognized for revenue, cost, and profit in the statement of profit or loss? So this is just to help us in understanding how to deal with the overall profits and how to ascertain our the revenue and then cost of sale. So first things first. Here we don't have any issue to determine our progress of the percentage of progress, because it was given to us straight away in the question to be 60%. That is 60% is the progress of completion. So here, first things first, we have to determine our overall. That is going to be step 1. So our step 1 is going to be here. We determine our overall profit or loss. We don't know yet. So remember that it's going to be basically your contract price. Your contract price. Remember that it is in dollars. So let's take 3 zeros. It's going to be 800. So that is the question. We have the contract revenue, contract price, and then remember that we will less our cost to date. Cost to date. And the question is 320, and then the cost to complete. Cost to complete is 280. So we are lessing these two figures from these. So this plus this will give us 600. So we are getting a profit of 200,000 over here, $200,000. So that is our overall profit. Here we are just trying to see what we are supposed to do next. Okay, so now that we have ascertained our overall profit, we have to determine our revenue, and then we determine our cost of our cost of sale, and that will help us in determining our profit. So we want to see how much we are going to send to our statement of profit or loss. So let's come here. What will be our revenue in this case? We can have it at the down here. So what will be our revenue? So our revenue here is going to be the contract price multiplied by the progress of a percentage of progress. So it's going to be 800 multiplied by 60%, and this is going to give us $480,000 because we are spending 3 zeros over here. And then we now, after getting your revenue, so remember that your revenue is going to be your contract price in the question multiplied by the percentage of progress. In this question, the percentage of progress was given to us. So the next thing is to determine our cost of sale. And this cost of sale is basically comprising two things: your cost to date and your cost to complete. Now in the cost to date is 320 multiplied by the progress, the percentage progress. In this case, is going to give us, so if you multiply the cost to date by the progress, the percentage progress, you are going to get 192, and here you are going to get 168. So these two, we let these two, and we are going to get $120. And this $120 is basically our profit over here, our profit. And remember that this is supposed to be done in the P&L account, because in the P&L account, that is where you are going to have your revenue, and that is where you are going to have your costs of sale. And remember that the cost of sale comprises these two things. It's either we just take the total cost, we just sum this one, multiply by the 60%, which is the progress of percentage, and we get our profit over here. So the question was asking us what will be our revenue, what will be our cost, and what will be our profit, and we have gotten it over here. Now the question is saying that assuming we don't have the reliable information to determine all this, what will be our profit in this case? In this case, the cost to date is going to be your revenue. So your revenue in this case is going to be your cost to date, and then your cost of sale is going to be the same figure, which is the 320. So if you let's say the difference will always be zero. Either you don't get loss, you don't get any profit as well. So you break even anytime there is no information for us to determine our revenue and then our cost of sale. So this is very simple. So let's take one that doesn't have the percentage of progress and see how we can determine the percentage of progress, and how to determine your overall profit, and how to determine your contract price. Your contract asset. So here, how do we determine our contract assets? It's basically your cost to date. So here, our contract asset, which is the last step, or liability, is basically going to be your cost to date. Your cost to date, which is the 320. Remember, it's dollars and with 3 zeros at the top. And then you add our profit. Add our profit of 120. So here we were not told the amount that was received by the entity from the customer as at the date of the these calculations. Okay, we were not told. As at the date of these calculations, we were not told. So we don't know the amount due or the amount billed to date. So therefore, the summation of these two becomes our contract asset. Now let's take a typical question, and then look at how we can apply these steps in solving it. Okay, so we are proceeding with solving this particular practical question, and remember that the question will have its link in the video description, so you can basically look at it and get access to all the questions and the solution. We'll go through it shortly. So we were told that on 1st January 2021, Ronas entered into a contract with a customer to construct a special building for consideration of 2 million plus a bonus of 0.4 if the building is completed within 18 months. So here the contract price is 2 million, but it is having a clause, an antecedent clause that if they are able to finish the construction within 18 months, then they will give them an additional amount of 0.4 million, that is $400,000. So here, let's establish our ingredients in the question. Our contract price is $2 million. And then the additional 0.4 is as a result of if you are able to complete the building within 18 months. Let's see if Ronas was able to complete the building in 18 months. We will add the 0.4 to this contract price. So continuing with the question, we are told that the estimated cost to construct the building are 1,500,000. So this is the total cost. The estimated cost to complete, not to complete, but to construct the building. So that is our total cost in this case. So our total cost is going to be 1.5 million. In this case, that is the total cost to complete, not to complete, but to construct, sorry. So estimated cost to construct the building is 1.5. If the contract is terminated by the customer, Ronas can demand payment for the cost incurred to date plus a markup of 30%. So this clause 2 is just in the question that anytime the customer terminates the contract or breaches the contract, Ronas, who is the entity, can sue for damages and with the cost plus a markup of 30% profit. And I don't think in the question the customer breached the contract, so that information also becomes relevant to this particular question. And then on 1st January 2021, as a result of factors outside the control, such as weather and regulatory approval, Ronas was not sure whether the bonus would be achieved. So here we are told that means they couldn't construct the building within the 18 months. Then the 0.4 bonus there is also becomes irrelevant to this particular question. Now at 31st December 2021, 2021, Ronas has incurred a cost of 0.1 billion. So this will be probably our cost to date. Our cost to date is $1 million. And then they are still unsure whether the bonus, so they are still unsure. And then we are told that Ronas has received 1 million from the customer. So he has received an amount. After that date, he has received an amount of 1 million from the customer, and that is what we call our amount billed to date, which is $1 million. Now we are told that the Ronas decides to measure the progress towards completion based on cost incurred. So here is going to measure the percentage of progress using what the cost incurred. So how do we go about this question? This is the question on what, how do we go about it? The first things first, what's the requirement? The requirement is how should the transaction be accounted for in the books or in the financial statement of Ronas. as at 31st December 2021. So the contract was entered into on 1st of January 2021, and then our requirement is to prepare the statement or show how it will affect the financial statement on 31st of December 2021. So between the time they enter into the contract and the time we are reporting, it is 1 year. Now, the first thing first, how do we determine our overall profits? How do we determine our overall profit to see whether the entity is going to make a profit or loss? That is step one. So our overall profit or loss in this case is going to be our contract price. So this is in millions, so they are in dollars as well, so we can just take the 3 zeros. Contract price, which is at 2 million, so it will be 2,000. And then here we can just go ahead and less our total costs, because the total cost comprises the cost to date and then the cost to complete. So here we don't have the cost to complete, but we have cost to date and cost to complete. Therefore, cost to date and total cost. Therefore, our cost to complete will be the difference between this and this, which will be $0.5 million. So we don't have the cost to complete, but we can ascertain that. So here we just less our total cost of 1,500 because our total cost here is 1.5 million and get a profit of 500. This is an overall profit. So remember that once you have ascertained the overall calculations to be a profit, then you are supposed to determine the revenue and then the cost of sale. So how do we do that? So let's determine our revenue and the cost of sale. This is going to be our P&L item. Alright, so what is going to be your revenue here? So your revenue is going to be your the contract price of 2,000 multiplied by a percentage of what? Of a percentage of progress to completion. We don't know that one. Let's determine that. We said we should use the input or the information available to us. We can use the input method. So let's look at our progress of completion. Remember that it's going to be your cost to date divided by the total cost multiplied by 100. So here your cost to date is 1 million. So that's going to be 1,000 divided by 1,500 multiplied by 100. And this is basically going to give us 66.67%. 66.67%. So we multiply our 66.67% over here to add the level of percent over here, and then the revenue is going to give us 1,300 over here. So this match to this, so 1,300. Then what is our cost of sale? Our cost of sale is basically going to be the 1,500 multiplied by the 66.67%. Remember that the 1,500 is the total cost. So it's either you do the cost to date and cost to complete, or you take the total cost. It's the same thing. And if you do that appropriately in the question with 1,500, we are going to get an amount of 1,000. So if you do that properly, you are going to get 1,000, and then our profit here is going to be our 300. So our profit here is our 300. As simple as that. And then how much are we going to send to our P&L account? How much are we going to send to our statement of financial position as our contract asset or contract liability? So in this case, our contract asset is going to be the so how do we determine our contract assets or our contract liability? In this case, it's going to be the cost to date. So cost to date is the amount is 1,000. So it's 1 million. So here it will be 1,000 because we are taking the 3 zeros at the top. And then our profit, we add our profit. So here we are getting a profit of 300. Please remember that it's not the overall profit, but the profit that you are going to send to your P&L account. So the profit is going to be 300 over here. And then we will less our amount billed to date. Then we were told that the amount due to date, the amount received from the customer was $1,000. So here we less this from this, we add this and less this one, we are going to get 300 over here. So that's going to be our contract, because the positive figure is going to be our contract price. So basically, this is what you will send to our statement of financial position as contract price. This one will be added to our revenue in case we have more than one revenue. In case you are preparing a full statement, then this will be added to your revenue, and this will be added to your cost of sale, and this will probably be the result of doing that. So this is how to go about such questions when any time they fall. Right. So let's quickly look at the next question to also establish our understanding. It said on 1st January 2021, Castle enters into a contract with a customer to construct a special building for a consideration of 10 million. So the whole cost of the building is 10 million. So that becomes our contract price. That becomes our contract price, which is $10 million. Then we are told that the castle is not able to use the building themselves at any point during the construction, but at 31st December 2021, that is 2021, castle has incurred a cost of 6 million. So that is our cost to date. Cost to date, that's what we have prepared account, and that's the amount we have, the amount of cost we have incurred to that date. So our cost to date is 6 million. And then we're given our cost to complete. Let's read on. So our castle decided to measure the progress towards completion based on cost. So we decided to do that based on cost. Now, to date, castle has received 3 million from the customer. Castle has received 3 million from the customer. So we have jumped one of the information. They said cost to complete are, so we have cost to complete and cost to date. So cost to complete in the question is also 6 million. So cost to date and cost to complete are 6 million, and then amount billed to date, amount received from the customer to date, because the amount billed to date is 3 million. Now, what's the requirement of the question? How should this transaction be accounted for in the year ended 31st December 2021? Please, one thing that I have not informed you that sometimes you may be given the second year. You may be given the requirement will be in the second year of the contract. If that is the case, remember that anything that you have done, any revenue and cost of sales you have recognized in the previous year must be taken from the current one, because it's not a cumulative something, it's annual. So anytime it's a second year and you have already, the business, the question has informed you that you have already recognized a revenue and cost of sale previously, then that must be taken from your current revenue and must also be taken from your current cost of sale before you can get the current profits. So let's use this question. When we get there, I'll use it to explain what I've just said. So with this question, what are we looking at? We are still looking at what is our overall profit or loss. Then we look at what we will take to our profit or loss account as our revenue and cost of sale, and probably look at our contract asset or our contract liability. All right, so our overall profit or loss. So first thing first, our contract price. So it's in dollar. Let's take the 3 zeros here. So 3 zeros over here. So that will be 10,000. And then our total cost over here, to make the work very easy. So total cost is going to be the summation of our cost to date and then cost to complete. So 6,000 plus 6,000, that's going to give us 12,000. So here there is a loss of 2,000 over here. There's a loss of 2,000 over here. And this is what I'm saying. Anytime there is a loss, then this loss must be equivalent to the loss that you will get or you will take to our P&L account. The overall loss must be equivalent to the loss you will take to our P&L account. So now let's see how much we are taking to P&L account. So our revenue here is going to be the contract amount of 10,000 multiply by the percentage of progress. We don't know that one, but with the information we can ascertain our percentage of what? Progress. So our progress of completion, so that is going to be step 2. Our progress of completion is basically going to be the cost to date, which is the 6 million divided by 6,000 divided by 12,000. 12,000 our total cost. The summation of these two multiplied by 100, and this is going to give us 50%. 50%. So here is going to be multiplied by 50%, and this is going to give us 5,000 because we have taken the 3 zeros here. It's supposed to be 5 million, but the 3 zeros is making it 5,000. Then what will be our cost? Our cost of sale. Our cost of sale is going to be the total cost of 12,000 multiplied by 50%, and this is going to give us 6,000 over here. So we are going to get a loss of 1,000. So we can see that this loss 1,000 does not tally with the 2,000. At a point in time, I told you that this loss here must always be equal to this loss. So you might just write provision for the loss, and then you bring your loss, the 1,000 back, so that you can get the loss of what? 2,000 to be sent to your P&L account. What I was saying earlier on is that anytime, assuming that already we have recognized the revenue on this particular contract from the previous year, then when we come here, the revenue we have recognized already must be less from this one, and then the cost of sale we have already recognized on this must also be less before you establish their new revenue and their new cost of sale as well as their new profit. Now let's look at whether we are going to get a contract assets or a contract liability. Contract asset or a contract liability. So in this case, the cost to date. So cost to date is 6,000. So alright, so the cost to date is the 6,000, and then the loss is basically the 2,000 we have as a thing over here. That's our loss, and the amount billed to date. The amount billed to date is 3,000. So if you less this, you are going to get 1,000. So our contract asset is going to be 1,000 that they are going to send to our statement of financial position, and the current asset as 1,000 as our contract was asset. Contract asset. It's a current item because of the annual recognition of revenue on the contract. Okay, so let's quickly look at the last question on the performance obligation performed over time to establish our understanding. So like I've been emphasizing, the questions will be in the description the video description. The link will be there so you can ascertain the question anytime. So on 1st January 2021, Ronas enters into a contract with a customer to construct a stadium for consideration of 100 million. So here we have entered into a contract for a consideration, which is our contract price. Our contract price of 100 million. So let's go on. This contract is expected to last for 2 years. So here we have been given the duration of the contract. In the previous questions, we've not been given the duration, but it shall be given the duration. So the contract will last for 2 years. All right. As at 31st December 2021, Ronas has incurred a cost of 24 million. So the cost to date is $24 million. And then we also told that Ronas, again, in addition to this cost, Ronas purchased a plant that was used for the construction, and this plant cost us 16 million. So a new plant was purchased on this date, which cost $16 million. And then this plant was purchased on 1st January 2021. So the plant was purchased on the date that we entered into the contract. And the plant is having no residual value after the year end, and the depreciation on the plant is to be allocated on a straight line basis across the contract. So here we are supposed to depreciate the plant across the years of the contract. Basically, the annual depreciation is going to be the 16 million divided by 2, because they said the duration of the contract, which is just 2 years. So here we are going to get the annual depreciation to be 8 million over here. The annual depreciation is 8 million over here. And then we're also told that Ronas measures progress on contract using an output method. So here we are using that output method based on the value of work certified. So therefore we are expecting to see the value of work certified. So if you look at the last line, it said at 31st December 2021, the value of work certified was 45 million and the customer had paid 11.4 million. So the value of work certified, is 45 million, and then the amount billed to date. So amount billed to date is $11.4 million. Now, these are the questions we have. These are the ingredients in the questions. What's the requirement? How should this transaction be accounted for in the year ended 31st December 2021? How should we account for this? So I've jumped one of the statements. We have cost to complete in the question. Cost to complete to be 20 million. So cost to complete in the question is $20 million. All right. So the first thing first, what will be our overall profit or loss? Our overall profit or loss is going to be the contract price. So here our contract price is 100,000. Then we are going to less our total cost. Instead of doing it cost to date and the cost to complete, we can just add the two. So our cost to date was 2,400, that's 24,000, plus the cost to complete of 20 million, that is 20,000, plus the asset that we have acquired, the plant, is also a cost to us. And this cost was incurred on the date of the contract, so we have to add it to it. So we have to add the 16,000 to that, the 60 million. So this is the cost to date, this is the cost to complete, and this is the new plant that we added. So if you add this to this, you get 40. So we are getting an amount of 60,000 as our total cost. We less this to get a profit of 40,000 over here. So this is our overall profit. Overall profit is 40,000 in this question. Now let's look at what amount we are sending to our P or L account. Our P or L account. So here our revenue. So our revenue is going to be the contract price of 100,000 multiplied by our percentage of progress. We didn't determine that, so let's quickly determine it. So with the available information to us, we can only use the output method in determining the percentage of progress of completion. So our percentage of progress, in this case, we are going to use the output method. We say that the work certified over the contract price. So the work certified here is 45,000 divided by contract price of 100,000 times 100, and this is going to give us 45%. 45%. So we multiply this by 45%, and that is going to give us an amount of 45,000. Then our cost of sale here is going to be our total cost, which is 60,000 multiplied by 45%, which is the progress of completion. And in this case, if you do that correctly, it's going to give us an amount of 27,000. So we less this from this, and we are going to get a profit of 18,000. So that's going to be our profit over here, 18,000. Now let's go to the statement of financial position, and then let's account for. So here, remember that after this one, we are supposed to bring a depreciation. So a depreciation of 8,000, because that's our annual depreciation over here. Okay, so when you go to your statement of financial position, two things come there. So non-current assets, because you have the carrying amount of the assets, the plant still remaining for the second part of the year. So that is going to be plant. So the plant is going to be 8,000. So this is the carried amount of the plant, because we are at 16,000 and we are just using for 2 years for the duration of the contract, and which is what, the 2 years. So here our cost of 16 minus our 8, our annual depreciation or our accumulated depreciation gives us a carried amount of 8,000. Now what will be our contract asset in this case? Contract asset in this case is going to be our cost to date. So our cost to date is going to be two costs, the depreciation and then the cost to date we have in this question. So our cost to date here is 24,000 plus 8,000. Why? Because the depreciation is also a cost to us. It's also a cost to us. So 24,000 plus 8,000 is going to give us $32,000. Now we add our profit. So we add our profit. We add our profit of 18,000 to this, and this is going to give us 50,000. Then we less amount billed to date. Amount billed to date. So amount billed to date is 11,400. 11,400. We are less than that one, and this is going to give us 38,600. That is our contract asset. 38,600 is our contract asset. So with this type of question too, this is how you go about it. So now we have exhausted all the individual items, all the most important items. We are supposed to note under the step 5 of the 5-step approach in recognizing revenue. Remember that we recognize revenue when we perform the performance obligation, or we satisfy the performance obligation at a point in time, or we satisfy the performance obligation at a point in time. All the questions that we have solved will have their link in the video description, so you can get access to all the questions and look at how we go about them. Now, the last thing I would like to talk about under the International Financial Reporting Standard 15, the revenue from contract with customers, is the contract cost. Remember that this standard was actually established from the amalgamation of two standards. So that is contracts, IAS 11 and IAS 8 in revenue. Now, the contract cost is actually the last part of the IFRS 15. Now, here the standards give rise to explain two types of cost over here. We have cost of obtaining the contract, your cost to obtain the contract, and then we also have cost to fulfill the contract. So the cost to fulfill the contract is what we have seen all this while with the cost of sale. That is the cost to fulfill the contract. The contract cost is always the cost to fulfill the contract. Now, what is the cost to obtain the contract? Is basically an incremental cost. Anytime you want to capitalize a cost, or you want to capture a cost that you incurred in obtaining the contract, that cost must be an incremental cost. And remember that an incremental cost is any additional cost you incurred in trying to acquire it or trying to dispose an asset. So it must be an incremental cost, and those costs must be capitalized. And this, I'm not going to go deeply into it, because we have done this under IAS 16 property, plant and equipment, and even IAS 2 inventories, as well as IAS 38, that is intangible assets. Now, with the cost to fulfill, the standard prescribes that if this cost does not fall under any of the accounting standards, like the IAS 2 and IAS 16 property, plant and equipment, and those costs must be capitalized. And this one, the cost to fulfill, we have deeply looked at it under the performance obligation satisfied over time. So that is basically about the contract cost. It doesn't have any too much issue. The most important thing is how much you should recognize as revenue. So this is it for IFRS 15. If you have any questions, you leave it at the comment section and it will be readily attended to. Please do not forget to share the rich content with others so that we can all form part of the learning family. Thank you.